All yours, Bill.
Hello, everybody. On behalf of the Councilors of Real Estate and our chair, Marilee Utter, it is a distinct privilege to welcome you to this session of What's Next for Real Estate and the Life Experience. Economic outlook and debate, policy changes affecting real estate. Thank you very much for joining us. My name is Bill McCarthy. I am the first chair for the councilors for this coming year. I run my company, WPJ Mccarthy, up here in Burnaby, British Columbia, Canada, and I'm delighted to be with you today. The Councilors of Real Estate is a distinguished international group of accomplished leaders solving the world's real estate problems and challenges. Experienced, innovative, and credentialed problem solvers. Councilors practice in 21 countries and offer expertise in more than 60 real estate disciplines, all across asset types and property classes. Each of our 1,000 plus members have earned the prestigious CRE designation. This webinar series represents the very essence of compelling thought leadership which the Councilors of Real Estate are known for. To that end, we'd like to offer you a complimentary subscription to our peer-reviewed professional journal, Real Estate Issues. You do so by visiting us at cre.org/publications. And to learn more about the Councilors of Real Estate and its membership, please visit cre.org. I'd like to take a moment to recognize our 2022 sponsors, the Altus Group, Busak Real Estate, Equus Capital Partners, and WPJ Mccarthy and Company. Thank you for support and partnership. You are encouraged today to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed and we'll answer as many questions as time allows. We are looking to keep within the 1 hour time frame. We're privileged to have with us today two renowned economists and prognosticators with us today. These are the Moody Analytics' Mark Zandi and the Natixis' Joe LaVorgna. Moderating today's debate will be the CRE's own Doug Putas. Doug has served the industry for many years, including as the head of research and strategy for Bentall Green Oak, as executive director for NACREIF, and as the chief investment strategist of AEW Capital Management. He currently serves as an investment committee member of Tristan Capital Management, a pan-European real estate advisor. So welcome again, members and guests, and I'd like to turn it over to Doug.
Thank you, Bill, and welcome to all who are joining us today. As Bill said, I'm Doug Putas, the moderator for today's session on the economic outlook. If I do my job well, you will learn a lot from these two panelists and will barely remember my presence. So on to the show. I had some comments introducing them, but I'll just weave those in as we go. So I'm going to start right off. Joe, your Valentine's Day tweet was short and to the point. Quote, 2002 was looking more and more like a stagflationary bust. Seems like a good place as any to start. All yours.
Thank you, Doug. I also tend to be short. Well, I'm always short and I try to be to the point. So that was very apropos on your tweet acknowledgement. Let me say a couple of things, and then we'll obviously touch upon the real estate market as we go through. Number one, the economy is going to slow. Two, inflation is going to slow. We could debate the rate, but it's going to slow. The Fed won't tighten as much as the consensus of economists believes, and if it does, it'll be drawn out over a longer time period than the 8 quarters or so that right now markets or economists are predicting. There are risks which we could talk about, which I like to talk about at some point, Russia, Ukraine, and then sort of by default, China, perhaps Taiwan, and then of course, midterm elections, which should be, again, I think interesting for markets. Why is the economy, why did I say stagflationary bust? Well, I should be clear, it's really stagflation with a little s. It's not stagflation with a big S, like we saw in the 1970s when you actually at points had reasonably firm real GDP growth, but inflation was running upwards of 10, 12, 13%. We're not going back to an environment like that. However, in a world, let's say where GDP is sub 2, if inflation is running at 3 or 4, I probably have a lower number than the 4, maybe something closer to 3. then in that sense, you have stagflation, but it's stagflation with a little s. The reason I say bust is because to me, the risks to growth this year are to the downside. After thinking 2021 would be a boom year, and it was, best GDP measured Q4 on Q4 since 1984, we are having a bit of a bust this year. I see growth well under 2%. But again, with inflation still high, and even though it's likely to come down, we will have some stagflation in that regard, with your inflation rate running above your rate of real GDP growth. And on the Fed, we do expect the Fed to raise rates. I'm sure Mark and I will agree on the timing of the Fed hikes, which will occur next month. The amount and trajectory and magnitude of hikes we might disagree on, but the Fed, at least initially, will respond to this inflationary bust by raising rates, and that's when the fun will begin, Doug. So I'll leave it there. Thank you.
And to you, Mark, your response.
Well, Doug, thanks. And counselors of real estate, thank you for the opportunity to participate today. And it's good to be on with my good friend, Joe LaVorgna. So this should be a lot of fun. So appreciate the opportunity. I'm optimistic. I think that growth will slow this year, has to, because the economy has been growing very, very strongly. But even despite a slowing in growth, I think the economy will be back to full employment, which we can debate what that means, but probably an unemployment rate that's in the low to mid threes, kind of consistent with where we were pre-pandemic by the end of the year. And I expect inflation to moderate. It's 7.5% on year over year on the consumer price index. If you told me it's about half that by the end of the year, I'd say that sounds about right. And that by mid-2023, I would expect it to be close to the Federal Reserve's target, which for CPI is somewhere around 2.25%, 2.5%. My optimism is based on a number of assumptions. I'll mention two quickly. The first is the pandemic. I expect the pandemic to continue to wind down. And what I mean by that is that each new wave of the virus, and I think it's reasonable to expect additional waves, but each new wave will be less disruptive to the healthcare system and economy than the previous wave. So Omicron did a lot less damage than Delta did, which did a lot less damage than Alpha did, which did a lot less damage than the wave that hit us at the start of the pandemic 2 years ago. That trend will continue. And as that happens, global supply chains will work out their problems. Labor markets will normalize. Energy markets will get back to something more typical, and we'll see, inflation moderate. Second key assumption is the Federal Reserve. The Fed does need to begin normalizing policy quickly. Even abstracting from the pandemic now, the economy is close to full employment. And growth is strong. It doesn't make any sense to be maintaining an interest rate, a short-term rate that's close to the zero lower bound. So I do expect the Fed to begin raising rates at the mid-March meeting, quarter point. There's been discussion about a half a point hike. I think it's a reasonable discussion, but I suspect about we'll get a half a point. 4 rate hikes this year, but I wouldn't argue with anyone who said 5, 6, 7. 4 rate hikes next year, and the funds rate will settle in somewhere around 2.5%, kind of spring, summer of 2024. I will say I do expect long-term rates also to rise. I know that's very important for commercial real estate investors, in terms of cap rates. The 10-year bond is sitting somewhere around 2%, a little less than that today. If you told me it was about 2.5 at the end of this year, and long run, it'll settle in around 4%, I think that's kind of where we're headed. I will say, and I'll end this way, obviously a lot of risk around everything I just said. And I do think, the risks that inflation remain higher for longer are not inconsequential. They're significant. And I do think there are, it's going to be difficult for the Federal Reserve to kind of land the economic plane gracefully on the tarmac here. There's going to be at least a few bumps, and, I acknowledge the risks that it could be much more difficult than that. So I think there's a lot of risk, mostly to the downside, but I do think the most likely scenario, kind of in the middle of the distribution of possible outcomes, is a more sanguine one where we come into full employment and year end with inflation moderating and the economy doing pretty well. So relatively optimistic outlook.
Okay, so before I want to just continue here for just a second with, I think you basically answered this, both of you, but do you think that there's more risk of the Fed erring on the side of too much tightening or not enough tightening? Joe, do you want to? I think you already answered this, but I just wanted to verify. You're muted.
What I would say is that the Fed is, I don't see the Fed having to go as much as Mark mentioned, although we've already started to price the scenario that Mark suggested. And I guess my fear is that as we begin the process of interest rate normalization, we're going to kind of see what cracks there are in the system as it relates to financial stability. There was a former Fed governor, Jeremy Stein, and I'm going to paraphrase, but made a great point about monetary tightening. It kind of fills in the cracks on like a floor. The water goes in, it kind of fills in those cracks. And what we're seeing now is I would argue, fairly, I don't want to say concerning, but it is a response in the market, a fairly dramatic tightening of financial conditions when we look at credit spreads, investment grade, high yield. We're seeing a little bit in the leverage loan market, equities. And I don't think the Fed can go as much as what people think, and actually necessarily what is priced into the markets. And I'll give you one last example. If you looked at the euro-dollar strip curve, what you found a couple of days ago was there was about 200 basis points of tightening priced into the market, but then the market actually started to price some easing around the middle of 24. So I don't think the Fed will go 8 times. I believe our star, so it's known, is closer to 0 in real terms, and probably around 150, 175 in nominal terms. And that's probably where Mark and I would disagree on things. So I don't think the Fed, to answer your question, Doug, I don't see the Fed going as much as it thinks or as much as the consensus of forecasters think. And if that's right, we probably won't see rates go up much higher on 10 years, say, which in a weird way, that I'm a growth pessimist perhaps, but I'm an interest rate optimist.
Well, to answer your question, I think the predominant risk is that the Fed does too much, meaning they press too hard on the brakes, resulting in a much, much weaker economy or even a recession in 2023. And that goes to the number of issues, one of which is, very difficult to navigate monetary policy with all the things that are going on in the macro economy. I mean, the pandemic, it's still on, and who knows, what direction that's going to go. You have all these various geopolitical events. Top of mind right now is Ukraine, Russia, and that, it looks like could be a problem, in terms of energy prices, energy markets, and that has all kinds of implications. Fiscal policy, at this point, it doesn't feel like we're going to get any additional legislation out of Congress, but it's certainly, I don't think the Democrats have given up here. I think they're going to take another crack at it, and we might be surprised. And then there's the unknown unknowns. Those are just the known unknowns. So, navigating, and we're all relying on the Federal Reserve to kind of land that economic plane on the tarmac, and all this other stuff is kind of the headwinds, the tailwinds that they're being buffeted by. So it's going to be very difficult for them to do that. The other thing I'd say, the other issue for them is, Joe mentioned financial conditions. The primary link between what the Fed does in the economy, at least the most important link early on, is through so-called financial conditions. What does Fed policy mean, and expectations about Fed policy mean for stock prices and credit spreads in the bond market, cap rates in the commercial real estate market, housing values, even crypto prices, because they're playing more of a role. And I'd say so far, the tightening of financial conditions, and they've started to tighten, right? 10-year treasury yields are up. We see today now the stock market feels like it's down 10% from its peak, kind of a typical correction. Credit spreads have started to widen out. We haven't seen any reaction yet in real estate markets, but that always takes a little bit longer. But the reactive tightening in conditions that we've observed so far has been relatively modest. I don't, particularly given what's embedded in expectations. I said 4 rate hikes. That's my baseline, but I think market expectations is probably for 6. And you saw, some, Goldman's at 7, and I've heard, higher. So what's embedded, what the expectations that are that are embedded in securities prices is quite significant. So the point being, it feels like the Fed's really going to have to press on the brakes to get what they need out of the financial system and markets to get the economy where they want it to get it. And the harder they press, the more likely they make a mistake and they press too hard. Ultimately, the financial conditions react, stock market reacts, credit spreads gap out, cap rates rise, and boom, the economy is going to struggle with that. So I fear that that's the most significant risk here, that they end up pressing too hard, which, by the way, I'll end by saying that would be kind of classic, right? I mean, if you go back and look at past business cycles, many of them end exactly that way. You have an overheating economy, inflation, Fed starts to tighten policy and then overdoes it, and you have a recession. The plane doesn't land on the tarmac, it crashes.
Doug, I want to just add one thing to what Mark said, which is he answered it more clearly and cleanly than I did, which is, yes, if the Fed makes a mistake, it is going to be doing too much rather than too little. My point is that I don't think they need to do as much as people think. In other words, them doing too much is a much lower hurdle rate than what many in the markets believe.
Okay, great. I'm going to shift gears very slightly. Part of my introduction that Bill did for me was to say that, you two are at the point of economics, policy, and politics. And Joe, you were directly on that point, because you took what turned out to effectively be a leave from your job to go to the White House in March of 2020 as chief economist on the National Economic Council, and really was to deal with the pandemic, right? And I never had the opportunity. That must have been incredibly challenging, because at that point, the data got all messed up, right? All these kind of, it was hard to even know what was happening in the economy at that point, other than chaos. How does that play out with this? The Fed is, data driven, but data can be a mess at times, right? I mean,
Sure.
it can be hard to decipher. You want to
That's
just comment on that for a bit?
Well, the one thing is, and the financial crisis of 08, 09 had a perfect blueprint for what the Fed needed to do in a liquidity crisis, which effectively was created because the economy had to be locked down. And the Treasury worked very closely with the Federal Reserve, who both should get A+ grades. And of course, what normally took place over a period of months under Chairman Bernanke took basically days, or in some cases just a couple of weeks under Jay Powell. So that was extraordinary. And of course, a much deeper, prolonged depression was avoided. What I found from that experience, and what I think is remarkable, is the fact the US economy is extraordinarily dynamic. There's certainly things we could do to make it more efficient, to make it perhaps run a little bit more cleanly, run it better, et cetera. But generally speaking, it's remarkable how well the economy, and all things considered, as horrible as the event was and the deaths and everything else, it's amazing how quickly it came back. And while we're still dealing with some of those issues that are from the pandemic, as Mark pointed out, the virus is mutated, but in a way that generally has become much less pernicious, which generally is how things evolve, but that's good. But it seems to me that when I look overseas, I see other countries, either because of health policy or how their economies are set up, not having been as adaptable as the US. So on a sort of a note of optimism, it's remarkable how quickly things got better, and how I do think we're on this road to recovery. And by the way, let me just say, even though Mark and I both agree that risks are to the downside, I'm not looking for a recession. So when I say stagflationary bust, I'm saying, look, the economy is going to be a lot weaker than we think. And it's going to maybe get some people nervous, but I don't see a recession on the horizon. And the fact that we've come out of this pandemic much better than most anybody thought when we were going into it, again, speaks to the resiliency, the dynamism, the incredible ingenuity of the U.S. capitalist system.
So I'm going to give this as a toss-up, and either of you can answer it. I think you both have mentioned supply chain issues in your answer, and we hear that all the time. Can you delve into that a bit more? I think we in real estate kind of know about, timber and steel and other things. But Joe, you just mentioned that, our policies have been better than many of the other countries in response to the pandemic. And that's part of the cause of the supply chain issues, right? That the other economies that aren't growing. Can you just go, the news usually just says, oh, there's supply chain issues. And then they go and they show one specific case. Can you just delve into how that is going to continue to play out, but also how it's going to get better?
Mark, did you want Mark to address it since I spoke last and I could fill in? You want to do that, Mark?
Yeah, it's up to you guys. You
I don't want to monopolize the time.
Mark?
Go ahead, Joe. That's okay. Feel free.
Oh, so I would just say that I remember, so for example, I used to get calls. So in the NEC, National Economic Council, you get a lot of calls from industry. It sort of feels a little bit like your customer service. Remember, one of the issues was we had you have to listen to people and you try to help them to the best they can. But there are real issues with lumber prices, because what you had is the lumber mills were partially closed because of COVID restrictions. So, normally if you got this kind of demand for product, you'd run 24/7, but they couldn't run 24/7 because you couldn't get supervisors there. People had gotten sick, and you couldn't staff it so that it could run like that. And what the industry tried to figure out, and what they were successful is, okay, how can we figure out ways to meet demand in a way that we can increase supply to meet that demand, and sort of approaching it bespoke, but also what can we do to not get around the rules, but to make it so that we could operate in a safe, effective way, and not just take it for given that, okay, we can't operate. So I would just think that what I observed was just figuring out ways to do business more efficiently and better. And for a time, lumber, as you remember, went up to around 2000 or so, and they came down, and when demand remained robust, it went back up again. But that was just one example of how we tried to figure out ways to basically produce product. And of course, then it was people looking to source timber maybe more from Canada. There was talk about lowering tariffs on things of that sort to get the product in. So it was just sort of a much more hands-on, creative approach, whereas other countries which have had these zero COVID restrictions, which I don't think has worked. I think you always have to approach it like, how can we reopen in a safe way, in the safest way to let people earn a living and have a livelihood. And it's just not, without singling any one particular country out, it's clear that not everybody's done that. So I think when we talk about supply disruptions, yes, the US has pretty much gotten back to where it needs to be in many instances, but a lot of other places have not tried to figure out ways, or don't have the creativity to try to produce items in a way that they somehow meet the health authorities' regulations, but also meet consumer end use.
You want me to provide a little more color? Well, my sense of it is that when we talk about supply chain issues, it's really, broadly speaking, three things. One, factories shut down. So, if you go back to the Delta wave of the virus, when the supply chain issues really came to the fore, this was back last summer and fall, a lot of the factories in Asia, particularly Southeast Asia, just literally shut down. It's hard to remember back, but back then, Southeast Asia was very lightly vaccinated. So when Delta hit, it really did a lot of damage. So the kind of the poster child of that is Malaysian chip plants, semiconductor plants. They just literally stopped producing. They shut down because the government said you got to shut down because we want to contain the Delta variant. And that's a problem throughout industrial activity, throughout Asia at that point in time. The second aspect of the supply chain disruptions is in the transportation system, particularly the ports. The ports really, the moving things in and out got really problematic. again, because a lot of it was through Chinese ports and their no COVID policy. So if they saw one case, they would shut down a terminal. And, those are big terminals that a lot of goods go through. China is kind of the staging place for all the stuff that's produced in Southeast Asia, and the rest of China come through those ports and then come over to the US or to Europe. And then third is labor problems, because people got sick. Truckers got sick. Literally, they just couldn't work. I'm sick. I can't go to work, and that scrambled things. Even more significantly. So again, going back to the chip example, no chips, no cars, no vehicles. And by the way, it was everywhere. It was the U.S. vehicle production. It was Japanese vehicle production. It was German vehicle, all collapsed. No inventory, shortages, prices go skyward. And, the good news is all those things are starting to move in the right direction. So Malaysian chip plants are up. We're getting a lot of chips being produced. Vehicle production has picked up very nicely in the last 3 months. Inventories have hit bottom. They're coming back. The next step in all of this is to see those prices start to come in. And I would expect that by the spring, summer, that we'll start to see some, price declines in vehicle prices. And that, again, is a poster child for that kind of dynamic in all kinds of product markets around the world. So you will note that everything I said, though, revolves around the pandemic. This is because of the pandemic. And this is the root cause, the most significant factor driving the inflation that we're observing now. So if you buy into the narrative I just laid out for you, the diagnosis, that would suggest if the pandemic does wind down as I anticipate, these supply chain issues will iron themselves out and inflation will start to come in. And that's how I get from where I began early in the conversation, from saying inflation will go from 7.5% today to something half of that by the end of the year, and something close to the Fed's target by mid next year.
Can I just praise on my next question? I was going to go to demographics, but I'm going to phrase it as a supply chain issue in one sense, right? The labor pool. We have fewer jobs than we had before the pandemic, and yet we have an unemployment rate that's basically the same because we have fewer people in the labor supply than we had before the pandemic. The long form question is the one thing I always took for a 40-year career of doing this. I was an economic forecaster before I came into real estate 30 years ago. The one thing you always knew was the US population was going to grow. Back then it was 1%. It got down as low as 0.7, but you always knew it. But between lower in-migration and the pandemic deaths, and I believe lower births, and there's probably going to be lower births for a while with those things, all of a sudden we don't have much population growth, any last year. Is labor supply going to be something that we're going to really have to keep our eyes on in terms of, especially in inflation pressure, right? If there aren't enough people for jobs, then you're going to get more wage growth. Is that something you're worried about?
Joe, you want me to take a crack at that?
Sure. You can go and I'll follow up.
Okay. Doug, actually, that was a concern before the pandemic, right? Because the demographic trends were already firmly in place that we're experiencing now before the pandemic, most notably the aging out of the baby boom generation, you and our generation, we're aging out. And so even if immigration stayed where it was pre-President Trump and pandemic, we'd still see labor force growth halved. It was 1% per annum. It was going to go to 0.5% per annum. But then you throw into the mix less immigration, beginning with President Trump's immigration policies. And then, of course, layered on top of that is the pandemic effects. Just to give you a number, if you go back to the Obama administration, average immigration year in and year out, legal and undocumented, was about 1 million per annum. Last year, because of a combination of policy and pandemic, it was 250,000 at best. And that gives you a sense of magnitude. So both those things are weighing on the growth in the working age population. Going forward, I would expect immigration to start coming back. I don't know that we're going to go back to 1 million per annum, but it is going to start to come back. So that should help a little bit. But, regardless, we're in store for very weak working age population growth. Then layered on top of that is the participation rate. And that really got nailed here in the pandemic that goes to all those people that were sick or taking care of sick people or fearful of going to work, getting sick. I think it's also related to childcare issues. Even to this day, if you have young children that are in school, getting daycare is very, very difficult. It's kind of a chicken and egg problem. And I do think government support probably played somewhat of a role. I don't think that's playing much of a role now, but if you go back 6 months ago, it's probably playing something of a role. Labor force should pick up as we get, again, if you believe that the pandemic is going to wind down. And so that should help with regard to the growth in the labor force. But nonetheless, you add it all up and it's going to be a slow growing labor force going forward. The solution to that is really threefold, and I'll just mention them and I'll stop. One is we need more immigrants. We need to have a better immigration policy, both educated and lesser skilled. We have a dearth of workers across the board, and we're going to need more immigrants if we want to continue to grow. Second, we really need to think about how to get more people into the labor force. What policies can we put into place to make it the cost of work less and send people to go to work? Help with childcare, help with elder care, help with paid family leave, things that make it easier for people to go back into the workforce and to participate in the labor force. And then three, we need policies that help promote labor productivity growth. So infrastructure spending is a great example of that, because we need to see better productivity gains. If we can't grow our economy with more people, we have to produce more per person. And so anything we can do to improve productivity, more resilient supply chains, more labor-saving technology, infrastructure, those are the kinds of things that we should be focused on to make sure that businesses can increase their productivity so that they can continue to compete and grow the economy despite the constraints on the growth in our labor force.
Joe, do you have anything to modify or add?
What I would add, just to related to this, is that without the population growth, a certain level of productivity means that your potential growth rate is less. So if, for example, your productivity was 2 and your labor force, your population growth, I'm sort of interchanging the two. If that was at 1%, then you could grow potential at 3. So if we're basically flattish for a period of time, then the economy can only grow as fast as productivity rises. That's just true by arithmetic. And I do think there's some opportunity to participation rate, to get that participation rate higher, especially in the 55 and older cohort. And so for a period of time, you could have weak population growth, but you may have higher participation, which for a period of time will offset that. And hopefully we could get it maybe back to 63% or maybe even higher. So that's sort of what could happen. But absent higher potential, that just means that the equilibrium real rate is lower. So real interest rates are going to stay lower than they otherwise would be, both short and long rates. So that's something that people want to consider. And the only point that I'd make is that I'm not a big Phillips curve person. I never really believed in it. And a Phillips curve essentially saying, in its most vulgar terms, that low unemployment leads to faster wage growth, which essentially then causes a markup to inflation as companies pass on those higher prices. I don't believe that. Now that was, I think, becoming more consensus pre-pandemic. And I feel that, economists need, they always feel like having a model is better than not having one. So I know why the Fed and others focus on these sort of Phillips curve type analyses, but I'm not a big believer in it. So I don't believe if unemployment rate goes into the low to mid 3s, which I think is certainly possible, and I hope it does, I'm not convinced you're going to get a lot more inflation because of that. Because as Mark very clearly laid out, the factors that impacted the supply chains, those will dissipate. And I do think that by the time we get to 24, as Mark suggested, we're probably going to have an inflation rate that looks a lot similar to where we were back in 19 than what we have now.
Okay, I'm going to change gears a bit because we haven't talked really about real estate, and this is the counselors of real estate. And you two are not real estate experts, but you're big picture.
I pretend to be, Doug. I pretend.
Yeah,
I pretend to be. Yeah.
Okay. Will capital continue to flow into real estate as a hedge against inflation? One of the basic ones.
I think capital will flow into real estate because of the returns. If you have very low interest rates, obviously there's impact on cap rates. And you've got significantly, on the residential side, you're seeing a lot of opportunistic professional investors get involved in that space and throw capital that space because the return profile is excellent relative to the risks. Unlike the late, or I should say the mid 2000s, we don't have a leverage problem. Lending standards haven't been easy. There are no ninja loans, liar loans, and all these other different names that were given it to them that turned out to be pejorative terms now. That doesn't exist. We've got record low inventories across the US. We saw yesterday housing permits rise to their highest level since '06. Granted, in the commercial side, certain cities are doing better than others. But I would say, broadly speaking, Doug, yes, capital will continue to flow into the sector, both resi and commercial. I think the outlook is great. At some point, might be excessive. We overdid it on the building. We overdid it on the lending. I don't see any evidence of that at this point. Still very early stages.
Mark?
Yeah, I would agree that real estate, commercial real estate is a good hedge against inflation. Depends on the property type, of course. So depends on the lease lengths. So, multifamily feels like a pretty good hedge. The leases roll over every year and you can see rent growth is very strong. So yeah, I think that's the case. And that means I think real estate will do well relative to other asset classes in this kind of environment that we are in. Having said that, I don't think it gets away scot-free. Higher inflation means higher interest rates. I do think interest rates are going to rise. It's just a debate about how high they're going to rise, how fast. And that means cap rates will rise. I do think there will be some widening out in the spread between cap rates and the risk-free rate, just because they've been incredibly narrow and there is more risk out there, as the economy gets into full employment. And, we are going to see a few bumps and recession risks are going to, they're going to be more predominant in people's thinking a year from now than they are now. So I would expect cap rates to rise. And so, you do the arithmetic. I do think that, CRE prices go flat, in some cases, depending on the property type, go down in this environment. I do worry from a fundamental perspective, the most for office, particularly in big urban gateway cities. I do think remote work is a game changer. I don't think there's any going back on that. And I think that's going to really change the dynamics for the office market, and to a lesser degree, other real estate markets, including the single family housing market. So, I do think commercial real estate is a better hedge. It should benefit from that, but there's no getting away from the reality of remote work and higher cap rates.
I wanted to I'm going to turn to the audience questions in just a few minutes, but one thing that comes up, Mark, you and I are both on the Zillow home expectations forecast survey, and I didn't see Joe on there. He may be doing it anonymously, but I just did my new one. It just came out, so I just did it quickly so I wouldn't forget it. But the December numbers, the mean forecast for the next 5 years, so coming off the peak of 2021, not including 2021, was 4.3% per year growth, and the median was 4.5%. And you were 2. And when I say you, it's Moody's Analytics. Your name's on it with other people. And I was 1.2%.
Okay.
And I kind of look at it and say, we just had a 19. We printed a 19.
Yeah.
And at some point, this gets really hard. But then I read, there's this whole single family rental thing going on.
Yeah.
With the largest private equity firms buying up, I think it was 19% of single family transactions last year were institutional buyers for rental.
Long-term investors,
and as I look at it and think about the basis of the housing market, most home sales have been a two-way thing, right? Most buyers are not first-time buyers. So when you buy a house, you sell a house. Yeah. Well, these are effectively all first-time buyers because they're not selling anything.
Exactly.
you've really drained the market of a lot of its sellers.
Yeah.
Is that I mean, you're starting to see people saying this is a bad thing for the housing market, or being worried about it for the homeowner side of the housing market.
Yeah.
Is that a real thing to be worried about? Is that something where the commercial real estate industry has sort of moved in and is changing the economics of what has been largely individual homeowner dominated market?
Well, I love the way you frame that. And I actually had never framed it that way, that it's a two-way transaction, except when it's an investor, it's their first time buyer. So that's it takes inventory out of the market. So that's a fascinating way to think about it. And I think quite accurate. I think it's problematic in that if home ownership is a goal, and, since the beginning of time, that has been an important policy goal, is to promote home ownership, because that's the fastest way to build wealth, for the typical American household. And, particularly for low income households and for minority households, home ownership is critical to building that wealth over time. So if you can't become a homeowner, you're kind of locked out. At least that's been the thinking. And I think there's some validity to that. So if investors are coming in, and they are, 26% of home sales in the fourth quarter of last year, by my calculation, based on actual transactions, were to investors. About 20 were long-term investors. The kinds of, buy to rent that you described. The other 6%, by the way, are flippers, which, is another whole issue we need to perhaps talk about. But that's up from 15% a year ago. So it's all about investors, and that they are, they're going to make it very difficult for minority low-income households to become homeowners. It's just going to be particularly in the context of rising rates. Because the other thing that these investors have that the typical home buyer doesn't have is cash. They got a lot of cash. They just raise it in the equity market at a low cost of capital. And they turn around and they buy. Where, for the typical home buyer, first-time buyer, you need an FHA loan. You need, a GSE loan. So yeah, I think this is a very significant issue. I think the solution to it is not to say, Mr. Investor, Miss Investor, don't invest. I think the solution is we got to build more housing stock. And so if I were, sitting king for the day, I'd be thinking, long and hard about more LIHTC, more new market tax credits, there's a new neighborhood housing home tax credit to help rehabilitate dilapidated stock in the middle of large urban centers, increase the supply, and that will change the dynamics here in a significant way.
Yeah. Well, the 19% home price growth certainly means that the investors who bought all those homes in 2020 made an awful lot of money on paper, right?
Right. And by the way, 2% on the house price growth, that's we're going to get a lot of house price growth this year, even if the train stops tomorrow. Right. So if you look out, that means no house price growth, maybe even negative prices at some point in that 5-year period. So, and the only reason you don't get big negative prices is just because you're going to see fewer transactions. People just won't sell, right? So you won't even see the transaction. The shadow price will be negative, so-called shadow price, but the actual transaction price, you don't have transactions, so you won't see it.
So Joe, I'll let you respond, then we're going to turn it over to Bill for questions that have come in from the outside.
I'm listening to you guys talk about housing. I'm saying that the median and mean are right. You guys are too low on your home price forecast. You just convinced me it's going to be at least 4 or something in line with nominal GDP growth.
Well, it's not news that I'm wrong with my house price forecast. It'll be news if Mark is wrong with his.
No. I'm right with. Although I will say, for that Zillow thing, they I don't have a Zillow, but they give you a crystal ball. They literally give you a crystal ball if you won. I have 3 crystal balls. Of course, I've been doing it for 30 years. So, once every 10 years.
I have one for a third.
Oh, you have one? Okay. All right.
Well, thank you, Mark and Joe, very, very much for a lot of good thought and a very, very good flow of information backwards and forwards. And Doug, thank you. We're going to go to questions, but again, talking about housing up here in Canada, housing prices have doubled in 7 years. If you want to study illogical housing, come to Canada. Quite something. Okay, we're going to try to get some questions in. Again, we are trying to work on that hard stop. So I'm going to throw a question out, and Doug, once I ask it, I'll let you do the moderation, and both Mark and Joe feel free to step in. Question number one, if the Treasury bracket risk-free rate indeed goes up 150 to 200 basis points and cap rates do not prove as elastic, do you think that the real estate's risk premium, already skinny, does not adequately price economic downside?
Well, I will just start by saying that the real estate risk premium actually to me is not skinny right now because the risk-free rate has been so low and there's been some stickiness down. It's not as wide as it was, but we're starting at least above the historic average. But Mark?
I think spreads are thin. I don't think they reflect risk. Certainly for office and retail, potentially hotels. I think cap rates on hotels have gapped out have gapped out more, but I think spreads will widen going forward. I do not think real estate investors have come to terms with the reality of what the world looks like when the dust settles on the pandemic. In remote work is a fundamental shift in the way we live and work that has enormous implications for CRE. I'll give you a number just to make that point more concrete. Prior to the pandemic, 5% of the workforce worked remotely. When I say remotely, I mean remote, not hybrid, remote. If you told me, on the other side of the pandemic, when things kind of settle down, that we're at 20%, that sounds about right to me. And that it's going to rise over time because we're all going to adapt to the remote work environment. My son has a company, does LiDAR technology for construction. And the business he has is a virtual company globally. His biggest problem today is what happens if the Russians invade and take over Kyiv, because all his modelers that do the LiDAR, take the LiDAR pictures and put it into a digitized a picture of the structure, they're all sitting in Kyiv. So what does he do with it? That is a virtual company, and that's the future of a lot of what we're going to be doing. And they do not use offices. They do not. My son is in his apartment in somewhere in the middle of Philadelphia. That's where he does his work with a big server there and all his screens and everything else. So I don't think that the real estate investors have come to terms with what this all means, for the market. And at some point that will get reflected in those spreads, those cap rate spreads.
Thank you. I'm going to move to. Go ahead, Joe.
Let's let Joe answer.
Describe is two things here. What Mark said. One is the potential for productivity growth to be higher than the 1.5 to 1 3/4 it's been running at. And then secondly, also there's a tremendous amount of disinflation, not deflation in there, because, or granted, you might want a bigger house because you need now a home office, but it seems to be the ability to work that flexibly and efficiently. And I've experienced it firsthand. I mean, I sit on a trading floor, and it's remarkable how effective we can be, not even being with each other. So those points Mark made, I thought, are really interesting and very, very appropriate to how the world works. But again, it could mean, if you need less, less real estate in certain areas, commercial real estate in the city. I mean, David Solomon's wrong on his bet with Goldman. They're not going to need all that office space. And real estate, I mean, generally buildings can be a lot more efficient than housing. But that has tremendous implications for the outlook. But I look at it as being disinflationary, not inflationary, longer term. Because also too, you could even source your labor. My light went out over here. I got to move. You could source labor. We talk about labor force participation, but you might, be able to source your labor much easier. I mean, when I was at my old firm, we had a big team that was in Bangalore, India. My guess is now you don't have to get a team necessarily in Bangalore if you could find people that are in a similar time zone in the US, but they could work and they could just be remote.
Bill?
Okay, thank you. Yeah, excellent answers. And of course, the questions just keep coming. Here's the next one. With affordability only getting worse, do you believe that the single family rental market will be targeted for regulation?
My answer is no. Maybe subsidy, but not regulation.
Yeah, I tend to agree with that. I would say regulated how. I'm not quite sure, beyond the kind of landlord related regulation and laws that are already in place. I'm not sure how that would occur. So my instinct is to say no. I do know there's a growing resentment in many communities, particularly in the South and the West, where this is a much more predominant form of home buying. The investor shares in places like Atlanta and Charlotte and Phoenix are well over 1/3. So, these are Tampa. So I think communities there are growing more nervous about what this all means about the ability of people to become homeowners. So I know there's a lot of angst around this. So, maybe there will be some efforts to regulate, but I'm not clear how that would work. I'm not sure how.
And I'm just going to jump in saying, witnessing how difficult it has been for places to even regulate the short-term rental movements, which effectively are turning houses into hotels. And, you go to the zoning laws and say you can't run a hotel on a single family residential, but you can't prove it's a hotel. So it's really tough to think what even the local regulation would be.
Good points. Next question, 30-year mortgage. At what point do we look at the Japan model for a 35-year mortgage as something viable here to assist affordability?
Oh, interesting point. I have not heard any discussion around extending out the maturity, the maturity of mortgage loans. I mean, 30 years seems to be kind of cemented in place by the GSEs and the FHA. But that's an interesting point. I have. There is in the Build Back Better agenda, the housing policy part of that, a proposal that I actually worked on around a subsidized 20-year mortgage. So the idea was, you get a 30-year mortgage rate, but it has a 20-year term. So when you're paying, you pay down a lot more quickly and you build wealth, more rapidly. And it's designed to go to folks that are of low income, very low income, and whose family, they come from families that were not previous homeowners. There's a lot of discussion talk around mortgage innovation, but I have not heard the 35-year or 40-year. But that sounds like a reasonable way to go here, potentially. In an environment with higher mortgage rates and conflated with these high house prices.
Joe?
I'm not sure the 30-year is the best product. I don't believe anybody else has a 30-year mortgage. I know it's a real estate conference, so I don't want to get in trouble with anybody. I'll just leave it there.
I'll interject from north of the border again. Following the 2008 global crisis and crash, Canadian banks introduced a 40-year mortgage amortization that the then finance minister, the succeeding finance minister and the Bank of Canada governor policied out back down to 25 because of the stress test and the vulnerabilities of people who are perpetually paying a mortgage. Next question. With the pressure on supply chain and labor force, do you think there will be an increased shift to 3D printing as the technology is developing?
Depends on what the product is, but absolutely. I don't see why there would. I mean, the 3D printing is already, you're seeing it even in, I believe in some instances, even in homes, correct? I don't know how prevalent it is, but absolutely. In fact, I think that's, necessity is the mother of invention. And you're going to see that, again, with remote work, people operating more efficiently and in ways that maybe were heretofore unheard of. And yeah, why not? Why not, Bill?
Yeah. Okay. I'm going to ask one last question, because this one is basically you're going to have to put on your crystal ball hat. It's a big one. Given how the price of residential real estate has gone, pardon me, wrong one. Industrial development is booming. Office is looking at changes as the workforce decides what it will be doing long term. and retail is reinventing itself. What do you think we'll see with these sectors in the next 5 years? So office, retail, and industrial.
Joe?
I was going to have Mark is much better at the real estate than I am, so I was going to have him. I was going to have him go, and I'm just going to piggyback off of what he said and sound semi-smart.
Well, I mean, I think industrial warehouse, the road there is clearest, right? Because the increasing use of online retail, that feels like a dynamic that is firmly entrenched and will continue. And that's not going to change over the next 5 years, I don't think. So that feels like, what we're observing now, just the significant expansion of, warehouse industrial space will continue apace. And I think there the development is, very strong and all the fundamentals are good. So that feels like the clearest path ahead. Retail, as it's kind of the flip, right, of that. So, brick and mortar retail, particularly malls, obviously have to reinvent themselves. Feels like that they're moving in a way that, like this historically they've been able to do this. They've been able to, change the kinds of things that go on in the space, and that feels like that's what's happening now. I mean, my own local malls. I grew up in suburban Philly. They're changing very rapidly into different types of uses. So I think that will continue over the next 5 years. I think they're exactly what the space is used for, hard to know, but if rents get down low enough, as Joe has been saying, we are pretty good at adapting, and I think we'll adapt. I think office is the toughest one because I think the real problems are office in big gateway cities. There's still going to be office demand. It's just different type of office in different places. And repurposing, some of the like 7 World Trade where Moody's is headquartered, or Joe mentioned Goldman Sachs, which is just across the street in the financial district. That's going to be tough. I think that is not obvious to me how that plays out over the next 5 years. That's why I keep saying that's where cap rates are going up. That's going to be where the issue is, because the road there is the darkest, or at least the most cloudy. It's just hard to see how that's going to play out.
It's interesting in New York, just you talk about buy the dip mentality, and something has to give. Either we're going to go back into places like New York or other big gateway cities, San Francisco, Chicago. You're going to get people are going to come back, or people think they're going to come back, and they bid up the price. Manhattan real estate has just soared because they learned after 9/11, the market came back. After the great financial crisis, the market came back. And I hope that's the case. But markets, and that's sort of why I was teasing, letting him answer the question first, because on the office side, I think it depends what area you're in. I mean, California has a lot of advantages, especially the climate. And you don't have the urban density like you obviously have in New York. So I don't know what happens in a place like New York or Chicago or some of these other larger, colder weather cities. I don't know. It's just, I really, either we're going to come back to something that looked pre-pandemic or something that's going to look a lot different. And looking a lot different means a pretty gut-wrenching, difficult transition. Would you agree, Mark?
Yeah, I think that's correct. Yes, indeed.
And I mean, Philly, is it like, take Philly? Philly is, you have the downtown, but it's fairly easy. When I'm in that area of the state, it's not hard to go from downtown to the suburbs. It's much more difficult in New York.
Well, that's true, but it's still not easy. So
yeah.
Well, let me end that by just thanking you, Mark, Joe, and Doug most sincerely. We have been truly in uncharted waters for these past 2 years, and there's no clear sailing ahead, but certainly your commentary greatly assists us in our deliberations. To have such high-level debate and discussion is a real pleasure, and the counselors thank you. The on-demand recordings are available for most of these What Next sections, and all registrants today will receive a recording. I hope everybody here joins us for our next presentation, which will be March 23rd, at-risk development. Look for the details soon, and please look at the CRE website. Until then, on behalf of the counselors, again, thank you, Joe, Mark, and Doug. And thank you, everybody, for participating. It's been a great session. And we wish you all well, stay safe, and we'll be in touch soon. Thank you, and have a good